All right, what's up, traders? Another one here from the Dark Side team. And in this video, I want to talk about which pairs you should trade. A lot of times people ask me, how do you go about creating a watch list? What pairs are on your watch list? Why are they on your watch list? What should be on my watch list? Which pair should I trade? How many pairs should I trade? All these questions. And this comes from everybody from rookie traders to seasoned veterans. At the end of the day, our goal is to be as efficient as possible. And the fact of the matter is, if you have a 50 pair watch list, it's not really going to get you anywhere. You need to have the most productive pairs for that particular week on your watch list, and that's going to help you be a much more efficient and effective trader. So I'm kind of going to go into that on here and a few things that I actually look into before I create my watch list. And my watch list does change all the time. Nothing should ever be the same in your trading. The pairs you trade, the style you trade, the market's evolving, so should everything you are doing. So just to get into one of the first things that I look at, first of all, is spread factor and swap fees. Now, for those of you guys who aren't familiar with what the spread is, you're going to need to go look that up. You should definitely know what the spread is by now. The important thing to remember about spread is the entire point of trading is to make money. The larger the spread, the more money that they take away from you. The larger the swap fees, the more money they take away from you. So you want to try to find a broker with the most attractive spread. Now, unfortunately for me, I'm in the US and we really don't have too many legitimate options as far as low spread brokers. I know all of my buddies that trade throughout Europe on the other side of the world, they all get to use IC markets and they're trading 0 pip, 1, 2, 3 pip spreads, which are excellent compared to what we're used to here. But for me, the most attractive spreads are the USD pairs, which are, the dollar pairs, the DXY pairs, UJ, EU, GU. Those are some of the most attractive with the smallest spreads, and they're anywhere between 2 and about 5 pips. But an important thing that I also factor in is what's going to happen during the rollover. Now, the rollover for me, being in Florida, it's trading in New York session, is at 5 p.m. Now, at 5 p.m., when the markets close, the spread goes crazy. This 2 to 5 pip spread will jump up to 50 pips. And on certain pairs, even over 100 pips. So, even though I'm trading the majors because they have the most attractive spread, I can still refine it down even more. Because for me, EU during the rollover around 5 p.m. and always check your local market to see what time your market closes and when your spread goes crazy. But for me, my EU goes from 2 to 5 pips to about 20 pips. But if, for instance, if I was trading USD Swiss franc, you chief, my swap fee is much higher. And not only that, but my spread between 5 and 6 p.m. goes to over 100. That's a ton of pips, guys, especially if you're trading low time frame. If you're messing around on the 5, 10, 15-minute time frame trading little local markets, a 100 pip spread is going to instantly take you out of the market for absolutely no reason. And the thing is, there's nothing we can do about that. So what do? We avoid it. We avoid it altogether. In other words, if I'm trading EU and I see it's almost 5 p.m., it's getting ready to be the rollover hour from 5 to 6, I might hold an EU trade if I'm in enough profit, but I'm not going to hold an intraday position on USD Swiss franc. Why do I want to have to absorb that 100 pip spike for no reason? Again, my goal is to make money, not to be right, not to have screenshots. I don't care if I have to close the trade. I'm going to close it because I don't want to have to absorb a 100 pip spread. There's no reason for that. The market, guys, is already hard enough. We don't need to make it harder by taking on situations that we can avoid, like stupid big spread hikes during the rollover, which for me, again, is between 5 and 6 p.m. So, check your local market and see what time your rollover is. It should be at the close of your local market, and see what happens with that spread. And I'm sure a lot of you guys have already experienced this, where you're in profit and all of a sudden, your spread went from this, and then 5 p.m. hits and your spread is now like this. And it makes no sense because you just got taken out of the market. And you can't blame your broker because that's something that happens every day. That's something that you signed up for when you agreed to that broker. And not only that, it's something that you can avoid by just closing the damn position. So always consider spread factor and swap fees. There's no need to pay high swap fees when you have the option to trade pairs that have less swap fees. Same thing with the brokers and the spread, So those are two really big things. Another thing that you're going to want to consider, depending on your level of knowledge, I guess, or your market IQ, is the average move. Now, what I mean by that is some pairs move a lot more pips than other pairs do in a day. For example, if this is US 30, if this is the Dow, DS 30 we like to call it, this little move right here, this can easily be 1,000 pips. Easily be 1,000 pips, no problem. Now, if we're looking at that same move on maybe GU and it looks about the same, it might only represent 50 pips. Okay, because these units are measured differently per pair. So depending on your experience level, if you know what you're doing, trading things like US 30, maybe even oil or any of these things that have, really high values per their pip, you can catch some huge moves and make a lot of money, and it's all is well and good. But if you're not really that familiar with stuff like this, you're going to want to stay, because those same 1,000 pips can go against you instead of for you. And maybe you're going to want to stick to pairs that are less volatile. So maybe not US 30, maybe not GU, maybe not GJ, because those and GA, those are the more volatile pairs. Those are the ones that have larger moves in an intraday perspective. They might move a lot more during London than, let's just say, AJ, for example. Aussie JPY might move a lot less. So depending on your skill level and stuff, you're going to always want to pay attention to how volatile a pair is. If it's a little too volatile for you, you're new in trading, then it shouldn't make your watch list. And now if it is a good pair that you like to trade, or maybe it moves well during your session, maybe you trade London, this pair is active during London, that's a pair that you would want to add onto your watch list. You see, that's why I say you can't just look at my watch list or whoever you watch that trades, because you're going to have your own little individual scenarios that you guys like to trade and that you like to see, And again, that brings us to our next one, scenarios. Scenarios is a huge thing for me, because I don't really care about the pair that I'm trading. I'm looking for a familiar scenario that I've back tested 1,000 times and seen it play out in a favorable result based off of my bias overall. So if I see something happening that looks good to me on EU, and I see that same thing happening on USD Mexican peso, that's an exotic pair. That's not something that I trade, but to me it would make no difference, because like one of our guys was saying the other day, if you didn't see the name of the pair up in this top left corner, if you didn't know this was the dollar index and you were just looking at a chart, you wouldn't know what pair this is anyway. You wouldn't even know. So the pair really doesn't matter. What you're really looking at is the scenario on the chart. So for me, again, that's why I don't care about the pair. The only reason why I will trade certain pairs is because they have more attractive spreads and stuff like that, which we mentioned before. So that's a big thing for me. You've got to trade scenarios that you're familiar with. A lot of people will say, I only trade GJ, I only trade gold, and look, that's fine if that's how you trade, but I'm not going to do that, because if EU is looking like this and I'm having healthy price action, lower lows, lower highs, lower lows, nice healthy price action, solid structure, and gold is looking like this, all right, and this is gold based off, this is the week of EU, this is the week of gold, and I say I trade gold every day, it makes no sense to me, because again, my goal is to make money in the market. I'm not going to trade gold. This is a sideways consolidated market. It doesn't give me any clue or any edge to take advantage of here based off of any strategy. So I have no business trying to decipher something like this. There's no reason for that. So again, I would trade a scenario. I would trade something that has clean lower highs, lower lows, clean structure, something that's more familiar to me through backtesting results. I don't backtest scenarios like this. I avoid them, because to me it's just a buildup of liquidity, which will ultimately, as you guys know from previous videos, be created and collected. So there's no trade there for me. So when it comes to making a watch list, you shouldn't just have two pairs. I only trade this, I only trade that. To me, it's not really efficient, because what you're trying to do is you're trying to decipher the composite operator's intricate plan on a daily basis. That's not an edge. To me, that's gambling, because you don't know what they have planned for that day. And why on earth would you avoid a market that looks like this to trade something like this? Just because you only trade GJ and gold, or because that's usually the ones that I hear people say. But why would you do that? It makes no sense. Trade scenarios that you're familiar with. If a pair looks like this, regardless of what pair it is, it should be on your watch list if it's familiar to you. Okay? Because again, If this didn't say US dollar index and I showed you this chart, you wouldn't be concerned about the pair. You'd be looking at what? You'd be looking at the overall structure. You'd be looking for maybe order blocks. You'd be looking for Fibonacci levels. You'd be looking for trend lines, whatever the case may be. So forget about the pair and forget about the whole I only trade this, I only trade that. If that's what works for you, I'll never tell you to stop doing it. But again, I really don't see, if the goal is to make money, which I think the goal should be, and the goal is not to be correct, but it's to make money, then you have no reason to be trying to solve these little intricate puzzles and be right and be correct and take a screenshot. You want to be making money. Put yourself in familiar scenarios and watch your money start increasing, okay? Put pairs, okay, on your watch list that are in familiar scenarios. For example, if you trade order blocks, okay? Just a quick example. If you trade order blocks, look for pairs that look like this. I would, if I traded order blocks, I'd look for pairs that have a break of structure and a clean order block that I'm getting ready to gamble on. That's what I would be looking at because it makes sense. And then from there, I would look at other pairs that are similar to this. So in other words, if this is EU, okay, I would also look at what else would you put on your watch list? You'd probably put on GU as well. Okay, you would probably look on maybe AU as well, Aussie USD, because all of them, EU, GU, AU, the whole basket is going to all look similar to this. AU might be like this, which is almost the same thing. GU might be like this, which is almost the same thing, because the dollar is the driver in the market on the USD pairs. So you might be looking at three pairs, EU, GU, and AU, and there's your watch list because you're an order block trader. All of them are getting ready to hit an order block. Now it's your job to try to decipher which one's the cleanest. 1, 2, or 3. And how do we do that, guys? Again, we look into the little things. We're here to make money. Which one has the lowest spread? Okay, EU's got the best spread. GU's spread is pretty good. AU's not as good. Okay, boom, that eliminates AU. Now we're looking at EU and GU. And again, your goal should not be to be in both of these positions. You should be in the most favorable one for you. So then you could think about it like this. Which one has the best swap fee for me? Based off my backtesting results, am I better off with the EU pair or GU? How my wins stack up? Does the euro have an interest rate decision or CPI or some kind of news event coming out that could affect it? Maybe so. So maybe that makes you eliminate EU. And then you're left with GU, which is your most solid setup. And that's the one that you trade. That's the thing, guys. You want to eliminate. The same way you try to refine a zone is the same way you want to refine your watch list down to the most efficient and effective pairs for that week, for that day, for that period, regardless of what it is. You always want to try to create the best edge that you have because at the end of the day, there's so many pairs to trade from. There's no reason that you should limit yourself to trading a pair that isn't an ideal scenario. If the pair is not going to give you the best chance of winning the trade, then why are you trading it? If the spread is too expensive and the swap fees are ridiculous, why are you trading it? If the average moves are tiny and you barely get any wins, if you are going to win, you barely get any pips, why trade it? If you're trading a pair that has an unfamiliar scenario or a consolidated market moving like this, why are you trading it? If you're trading a pair that you always get negative results in your backtesting, why are you trading it? You have choices. We have all those pairs. We have crypto. We have so many. Why are you trading pairs that you really don't need to be? You shouldn't be. You know what I mean? That's the real thing. You shouldn't be trading them, period. Again, look at your backtesting results, guys. Don't backtest the same pairs, all right? Backtest JPY pairs one weekend, backtest USD pairs one weekend, backtest, pound pairs one weekend. And then compare your results. It's fun. Look over your results and see which one did I do the best on. JPY pairs, I crushed it. USD pairs, I crushed it. GB pairs, I didn't really do too well. Perfect. Eliminate that. Again, that helps you refine your watch list. Now you're looking at USD pairs, maybe JPY pairs. Think about the session that you trade in. If you trade in certain sessions where pairs are more volatile, if you trade Asia, then it might make more sense for you to trade Japanese yen pairs, and boom, that helps you create a watch list that way too. Again, guys, refine. There are no perfect pairs to trade. There's only perfect pairs to trade that are perfect for you because everybody has their own individual outlook on the market. Everybody has their own style. Everybody trades their own session. Everybody has their own broker that's going to give them different spreads. And that's the thing, guys. You always want to consider as many things as you can whenever you're investing your money into anything. So again, my watch list for this week right now, I've got some majors. That's about it. Getting ready to have that USD interest rate decision coming up. So I'm watching that, and that's about it. And next week my pairs might be different. But I'm definitely not going to trade something that's not going to give me an attractive spread, or that's going to have crazy swap fees, or something that I don't have good results on back testing. And I'm 100% not going to trade a pair that I'm not familiar with that scenario. I will never trade something that looks like this just because that's what I trade. I would rather trade anything else in the world that presents a familiar scenario to me where I know I've made money before and I can make money again. So just some information for you guys. I hope you found some value in it, and we'll talk